My name is Katie Creed with CT and Associates through Cetera Investors. I hope you're all doing well. Today's Topic Tuesday is going to be on some of the basics of investing, so stocks, bonds, and mutual funds. Whenever I'm talking to clients, friends, family, we often hear the word stocks, bonds, and mutual funds through conversation, through the news, through media, whatever it may be. But what I often find is that people, where they might be familiar with the words, they might not truly understand what they mean. And also when talking to people, they don't tend to like the normal financial terminology, because if it's not your world, it doesn't always make sense, which I get. We all have our own industries that we work in, and everybody has their own common terminology that makes sense to them, but might not be so widely used. So what I want to do, within these Topic Tuesdays period, is always try to make it very much a safe space for people to get empowered so they can know about different kinds of advocating tools or resources or people or companies like myself and Abbey, but also to educate in a way that it makes sense to your brain. So if I'm ever doing a video and you're like, Katie, that doesn't make sense, I want to know, because I want to make sure that I'm addressing people in a way that makes sense to the masses. And I'm very much proud to be a part of our company where it is very much focused towards women and the LGBTQ community. That's what Abbey and I have always dreamed of wanting to help in service. So that's what we want to focus on. So for stocks, bonds, and mutual funds, let's start with stocks first, shall we? So when you own a stock, or what a stock is essentially a small portion of a company, ownership of a small portion of a company. And when you own a small portion of a company, that dollar amount that it's worth, the price, goes up and down based off two different things. I typically say one is through facts and then the other is through emotions. So when we're talking about facts, we're talking about how much cash they have on hand. We're talking about balance sheets. We're talking about what kind of changes that they're making within the company that's going to be either a very positive effect on things or a very negative effect on things. How are their layoffs doing? Are they bringing in new people? Who's their CEO, right? So those are some of the facts. Whereas the emotions, that usually comes from some of the decisions that companies make or that CEOs put out, either against a certain thing or pro a certain thing, or somebody gets on Twitter and somebody tweets something out and the United States people say, I don't agree with that. I don't want to be a part of that. So I'm going to sell my stock, or we're going to devaluate that price because we don't think that's a good decision, right? So when price of stock goes up and down, it can be both emotional and logical. And it's really hard as an investor to differentiate between the two, because there is no way to quite differentiate between the two. The price is the price. But why the price fluctuates can be based off of those two factors when we're looking at any kind of stock market out there. So I hope that helps. But when we're buying one share, one bit of stock, so one portion of a company, it's a very, very, very small amount. So buying individual stocks are sometimes hard for most Americans' budgets. Doesn't mean it's impossible to get. It just means the cost per amount that you're getting can be a bit costly because we can't diversify our portfolio always with that. Not that they're bad things, they're quite good. We just have to look at what somebody's budget is and if it's appropriate that they do buy individual stocks. The next area that people tend to ask me about is, okay, Katie, what are these bonds? I hear bonds, my grandparents talk about them. I feel like older individuals talk about them, or some of my retirees say, Katie, I need to get more into the bond space because now I'm getting into retirement. So why that's talked about is bonds are typically by nature less volatile than stocks are. And why is that? Well, what an actual bond is think of a mortgage, right? A lot of people understand the concept of a mortgage. A mortgage is a contract that you, as somebody wanting to purchase a home, gets into this contract with a lending institution. So maybe a bank or a credit union, and you say, you know, I want to buy this home, but I don't have, let's say, $250,000. I have enough for a down deposit of maybe $50,000, but the home's worth $300,000. So I'm going to need some help and assistance to purchase this thing that I want to. And what I'm going to do is I'm going to pay back principal plus interest. That's very similar to how bonds work. But now the roles have reversed. Now it's U.S. citizens, now it's people that are lending their money to corporations or governments or municipalities to be able to do a project, to be able to do something that they're really wanting to do. And what they're going to give back their investors is the principal plus interest. It used to be called like a coupon book because you used to turn in a coupon, anyhow, old terminology. But when we're looking at bonds, their prices can vary too. It's not that they're not volatile. They're just typically not as volatile as stocks. How bonds go up and down in price is usually dependent upon the interest rate that the Fed's put in place. So, for example, think of it kind of like a teeter-totter. When interest rates are low, bond prices go high. The old bond prices go high. When interest rates are high, bond prices go low. The old bond prices go low. So as an investor, you typically always want more money, right? You want the highest return that you can get. So when you're looking at what's in the marketplace and you see that you can get two different bonds, one bond is quite old and it's giving you a very high interest rate of, I'm gonna make up a number, 6%. And some of these new interests that are coming out for these new bonds are much lower. They're like 3%. Well, when the interest is your payment, the money that you're getting as an investor, do I want more interest or less interest? I want more, right? That's just how the economy works. You always want more. So when we're looking at the old bond prices that have a higher interest rates, those can charge a premium. Those can charge more money. They can increase their price because the new opportunities are much lower interest rates. They're going to give a less return. Does that make sense, guys? So when something is lower in price, it usually has to sell at a discount in order to compete with those higher interest rates. So the price of a bond can go up and down depending upon what its interest rate is and what the interest rate environment is currently. Because bonds are longer contracts by nature. So you're usually locking in maybe 5 years, 10 years, 30 years worth of a time frame. So just be mindful of that. Then when we get into mutual funds, now, mutual funds are more commonly used within the U.S. for the average middle American individual because of their cost efficiency. So what a mutual fund is it's basically like a grocery cart, is how I like to describe it. So this grocery cart is filled with a bunch of different stocks, a bunch of different bonds, or maybe a combination of a bunch of different stocks and bonds. And what this grocery cart is able to do is it's able to hire a portfolio manager. And that portfolio manager is the one that's picking what kind of bonds, what kind of stocks, what kind of combination of things are we putting within that grocery cart to make it as efficient as possible, to get it towards that goal that we want it to get to. And so with that grocery cart, if we're able to spread out the cost of that portfolio manager, that personal shopper, right? If we're able to spread out the cost of that individual, that institution amongst thousands and thousands of people, it's a much more cost-friendly way of getting some personal financial advice, really, when it comes to what kind of stocks and bonds you can have. And also it allows for people to get a diversified grocery cart filled with a bunch of different things at a much more reasonable price point that can work within their budget. So meaning you can buy monthly contributions, buy monthly shares, units, and I apologize, you can hear my dog. You can buy multiple units, shares within the budget that fits you. So meaning if somebody's able to do $50 every month, we can make that an achievable goal, versus trying to do that within the stock or the bond market can be pretty challenging, if not impossible. So we just want to be mindful of what's your budget, what are your daily activities, what are your goals, and that can help an advisor really select what's going to be the best opportunity for you as an individual within your portfolio. So when you have a mutual fund too, there's also different ideas in mind for each grocery cart that they have, right? So think of diets. How many diets are there out in the world right now? Tons, right? So somebody's grocery cart whose focus is the keto diet might look very different from a vegetarian grocery cart, right? So each mutual fund has its own goal in mind, has different objectives that they're trying to meet. So when we're looking at which mutual fund is going to fit each client best, that needs to be very much on our mind as to what's going to fit each person's need, whether that be risk tolerance, time horizon, what the goal is. Are we having our accounts within a retirement vehicle, or is this what we call a non-qualified vehicle? So there's tons of different things, but what we need to know as an advisor is, what do you want at the end of the day? So I hope that helped on just some of the basics between stocks and bonds and mutual funds. I like to get creative with how I say certain things because I think it helps to create a visual for people. But if you have any particular questions on any of those things, please feel free to message us to set up an appointment. We'd love to talk. But I hope you have a great rest of your day. Bye, guys.